Hello, everyone, and welcome. We are glad to have you with us today. We'll wait just a moment while everyone gets in from the waiting room. So bear with us here, and we will get started momentarily. Okay, I think we have everybody in. So I want to officially welcome you to this first of our QuickBooks Simplified series, 3 sessions, and we are so excited to have you here to join us on this QuickBooks journey. I am your moderator, Jenny Alton from the New York Small Business Development Center Central Office. This webinar is hosted by the NYSBDC. We are a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. In a few minutes, I will drop some information in the chat if you are interested in our free business advisement services for your business. Okay, so our presenter today, we have Christy Dudgeon, President of SBC Consulting. And thank you so much. I've seen Christy do these presentations before, and she does a fabulous job. So I'm just very, very pleased to have her as your presenter today. We also have her colleague with us, Darlene Rose Schultz, who will be helping to answer some questions in the Q&A and chat, and I'll talk more about that in just a moment. Okay, housekeeping now. So you know, we are recording today. We will share a link to resources from this webinar in a follow-up email. Attendees are muted and will not be on camera. And I will turn on our chats here in just a moment. Those chats will be visible to me and our presenters only. If you have questions, we would love to have you put those into the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window, and we'll have some pauses throughout the presentation to answer questions. We have a big crowd today, so we will answer as many questions as we can with time permitting. So we'll do the best that we can with everybody attending today. And I do want to mention as well that should you need closed captioning, that is enabled for this session. So you can turn that feature on from your Zoom options at the bottom of your Zoom window. All right, I have finished the housekeeping, and I am now turning the time over to Christy.
Thank you very much, Jenny. So to add to the note for the housekeeping, as she mentioned with all of the questions, I will try to keep my eye on multiple screens here as I go along. I'm sure I will miss some of them. Today's class is filled with information that's foundational. I'm speaking a lot at the end of it. We are going to go through the setup of QuickBooks. You are able to set it up on your end as well. This is typically where a lot of those questions come from because as we start to walk through those steps, you might fall behind with my speaking, obviously, because I need to keep moving the class forward. If you do run into problems with it, there will be an email that's going to go out after the webinar that is actually your homework that you can work on between sessions. And one of them will be a little bit more information about how to navigate that setup menu and some of those final pieces that I'm going to talk about at the end. So if you do opt to start your own QuickBooks while we are going through that, as I mentioned, I'll show you the steps to do that and how that implementation looks. But I will try to get to any questions of anybody that is doing that on their own as I speak. As I mentioned, this class is packed with foundational items. If you are new to bookkeeping, this is definitely going to be for you. We're going to talk about relevant terms and important information. Hopefully, I'm going to create it or speak to it in a way that you can understand. It's actually the way that I learned. When I first was starting out, I happened to be a small business owner at the age of 20. I had absolutely no idea what I was doing. I went to a women's business center. They helped me out. So I sat with someone very similar to me that taught me how to use QuickBooks. I've been using it for about 25 years now. I've gone through, desktop into online and all the changes that have come and gone with QuickBooks, as well as now the new AI integrations. So, if you are new to this, trust me, I was right where you are at one point, and so I try to convey all of this information as if I was learning it for the first time as well, as opposed to maybe an accountant standpoint where sometimes that can go right over your head, right? If you've not been there before. As Jenny mentioned, I am the president of SBC Consulting. We are a pretty cool team. We're based out of Ohio. However, we are remote and we are everywhere. We are currently working in 26 different states as well as 2 different US territories, which is pretty awesome. We also have consultants that are overseas part of the time because their spouses are in the military. So you can connect with me on LinkedIn. We do share information about all the workshops that we're having throughout the country with other SBDCs, just like New York is doing here for you today. So feel free to connect with us and chat with us in the future. So what are we covering today? As I mentioned, it's that big foundations. We're going to talk about bookkeeping basics. So what does it mean by that? I've tried to narrow it down to a 4-step process. Basically, if you do these 4 steps, you can successfully do bookkeeping. You can actually start doing it today. Business versus personal finances, what that means and why it's important to keep those separate. And then that actual setting up of QuickBooks, as I mentioned, which will be the very last piece of what we are talking about today. So what do I mean by bookkeeping basics and those 4 steps? So the first thing that we have to do, no matter what our bookkeeping platform is, even if it's not QuickBooks, right? If it's a piece of paper, we have to establish what's called a simple chart of accounts. It's actually called a chart of accounts, but I like to add the word simple because we want to keep this as simple as possible. And again, I said keep it simple, right? So what I mean by simple is we keep it as compressed as possible or as limited as possible in the number of accounts that we've got there in the chart of accounts. We eliminate anything that's vague or maybe potentially redundant because we might accidentally utilize that and utilize it incorrectly. So we're going to talk about what a simple chart of accounts looks like. We're also going to talk about what's going to happen when you start into QuickBooks because it's not so simple the way that they'll set it up for you, but I'll show you how to fix that. We also want to categorize all of our transactions accurately, and we'll talk about what that means. And then we need to reconcile monthly and then review our reports. We do have a question in the Q&A that I wanted to touch on. It says, will the workshops be available to watch later? Yes, they absolutely will. Jenny has already pressed the record button. So definitely when we get into those step-by-step on how to set up QuickBooks and obviously the next 2 classes where we're really in QuickBooks and digging in there and doing lots of different things, you will be able to watch these. Go ahead, Jenny.
Yes. So we had a question, and you may be about to address this, but this person said, are we supposed to have a QuickBooks application open right now to work along with the presenter? So I'll let you go ahead and address that. And also, I don't think we're seeing your slide share
We're not
yet.
sharing. Yeah, I
Okay,
just
perfect.
realized it clicked off. So I'm going to go back there.
Perfect.
So when I talked about all of my how to connect with SBC and all that, you missed it, right? So there you go. And then I will flip forward. So hopefully you can see that now.
We can. Yes. Thank you.
Perfect. Okay. All right. So back to my screen then. So you do not have to have QuickBooks open right now. I'm going to actually lead you through step by step on how to open that later, how to go through the pricing menu, choose the actual one that you're going to utilize. So don't worry about having that open now. If you don't have access to it at this moment or you can't open it on a computer, as I mentioned, the steps are going to be at the end of this, and then there will be follow-up as well. So if it's something that you want to add between now and the next class, and at least do the implementation of it. That beginning setup of it is very quick, actually, what I'm going to show you, so it's not real time consuming. And you can choose whether or not you want to do it between now and then. So the chart of accounts, as I mentioned, our 4-step process. I'll go back to my screen here since I skipped it. That simple chart of accounts, categorizing I mentioned, reconciling, and then reviewing those reports. So, step one, simple chart of accounts. What do I mean by that? So, a chart of accounts is a list of all the financial categories that are being used to organize your business transactions. So, basically, it's a simple way of every single dollar you make, every single dollar you spend, it has to match into one of these accounts. So, every transaction from now until the end of your business, right, is going to go against or go into one of these chart of accounts. A lot of people like to think of them as buckets. So I make this motion a lot. So you're taking that transaction and you're putting it in that bucket. It's the structure that tells your bookkeeping system where the money is going. I also like to think of it like the backbone of your entire bookkeeping system. So if you have a good chart of accounts, then you have a good foundation, good structure, right, for basic bookkeeping or even really extensive or advanced bookkeeping. So every accounting system in the world, even the greatest accountants, they all start with a structured chart of accounts in order to do this. So every dollar that comes in and goes out has to touch one of these accounts. Why it matters if we keep it clean, it's how we keep our transactions organized and consistent. It's funny, I usually say in these classes that as long as we're doing something consistently, we can sort it out, right? So even if we're doing it wrong, as long as we're doing it consistently, then we can sort it out. So we obviously want to move to where we're doing it correctly as opposed to wrong, but at least if we're doing it wrong, we can figure out where things went, right, as a group because they're going into this chart of accounts. But this helps us produce what are our accurate financial reports. So we've got to start with that clean chart of accounts in order to get good, clean, accurate financial reports. We need to understand where our money is coming from and going, especially as business owners. We have to know this level of information because we can make better decisions using that data. As small business owners, we do a lot on intuition, right? We think this is the good idea, and we're not really sure what the data means, or we don't have the data available. But we are developing this system, right, to get that data so we can make those really good decisions. It helps us also prepare for our taxes if we are seeking funding, right? Any kind of loans or even grants from that standpoint and financing. If your chart of accounts is messy, then your reports will be messy. You know, the given statement is bad data in, bad data out, right? So it will follow along. So, what do we need to know in order to set up a real or correct chart of accounts? So, we need to know five things to start with. You will hear me say these five things over and over and over again. We are going to go over them one by one, a little bit in depth, but trust me, you will hear me say them again and again and again until they are something that you can just regurgitate, right? Don't overcomplicate things. Keep it simple. That's why I start with five. After that, that's when we get things that are extremely complicated. So, what do I mean by the five things that we have to know? These are the main accounts or the main account types, is the other word that you will see in QuickBooks. And every single account that you create after that, or every single bucket that you create, falls into one of these five accounts. So this is the starting point. And we've got assets, liabilities, equity, income, and expenses. Now, there could be multiple accounts within each account type. That's where we can overcomplicate things. However, the base of everything starts with just those five. And if you can learn these five and you know what to do with these five, then you will be able to then make these decisions as you move forward to consistently start to categorize your transactions and have good financial reports. The assets are very first of those five. These are things that the business owns and they have a value. So remember those two pieces. Asset, we own it and it has a value. Common examples of these are our bank accounts, the cash we might have on hand, accounts receivable. If you're invoicing your customers or your clients, then accounts receivable is actually what that clock is until we collect that money. So accounts receivable becomes an asset because it's assumed that we're going to collect that money at a later date. Equipment and tools. So these are things that are of tremendous value sometimes, right? They usually are over a certain value. This is accountant dependent, so I always recommend if you're not sure if you have a piece of equipment or tools or even office equipment, um, if it should be an asset or an expense that we'll talk about here in a little bit, ask your accountant. They'll tell you, did it cost more than this amount, right? That might be $1,000, that might be $2,500, but that's how you make that determination if something is going to be called an asset. So it's usually got it's not just have a basic value, it's got a higher value. However, those bank accounts, accounts receivable are always going to be assets no matter what. Vehicles that are owned by the business, I state that because we sometimes use our personal vehicle, right? So we wouldn't necessarily call our personal vehicle an asset for the business because we own that personally. This would be something that the business owns. Inventory, so these are things we have on hand that we haven't sold yet. And then also property owned by the business, that would be considered an asset. Why these assets matter is they help us understand how much our business actually has. So when a bank looks at this, they look to see is this something you can sell, right? And get a value out of that. Somebody just said his property is leased, even then it will be an asset. No. So leases are not assets. Vehicles that are leased are not assets, right? That's the same as we're renting it. That's converting back to someone else. It's not something the bank can necessarily sell unless the lease is written in such a way that it's got an actual value associated with it. This helps us know for tracking cash and money that might be owed to us. Also, it shows our financial strength to our lenders and funders. So remember, I said they want to know, can I convert this to cash and cover all your debts, right? That's really what assets mean from a banking standpoint. And they help us make decisions about spending and growth. Assets tell part of the story of our financial health. There are five parts to our financial health, right? Because there's five pieces here. What are not assets are personal bank accounts, any personal vehicles or property, unless they are owned by the business or they're substantially utilized by the business. Again, that's an accountant question. Should that be there? Should that not be there? Expected future sales not yet earned. That's not considered to be an asset, but that we're just speculating that we're going to sell something. And loans that we've received, these are not assets. Sometimes we accidentally call those income if we've received the funds. That's not correct either. A loan is always a liability. Chart of accounts, then, knowing the other five. What is number two? So we talked about assets. Those are things that we own and they have a value. So a liability is something that we owe and it has a value. So it's got that tangible quantity to it, right, from a value standpoint. Liabilities are our debts. Common examples of these are business loans, lines of credit, credit card balances. Keep in mind, I just said credit card balances, accounts payable. So this is the opposite of what accounts receivable is. So accounts receivable, we sent an invoice to a customer. We're waiting for them to pay us. Accounts payable is a vendor has sent us a bill and they're waiting for us to pay them. So therefore, it's a liability because we owe them at a future date, right? We're not paying them right today, so we owe them at a future time. Payroll taxes that are owed. So if you have W-2 employees and you're withholding payroll taxes, those are considered a liability until we've paid them. Once we've paid them, then it's no longer a liability, right? Sales tax, exactly the same thing. So we are holding on to that sales tax we've collected until we pay it. And so that's considered a liability. And then equipment and vehicle loans. If our business has to pay it back, then it's considered a liability. Why these matter is that it helps us understand what our business is responsible for paying. It helps us plan cash flow and upcoming obligations. It helps us avoid surprises, taxes, or debt. Also show lenders that the debt is organized and accurate. And knowing what you owe helps you plan instead of react. I just saw a question about are gift cards a liability? In most cases, yes, they are, because you can't take revenue on those. And you also can expect at a future date that someone is going to come back to collect on that. That is an accountant question too, depending on how it is that you're collecting and organizing those gift cards. Common liability confusion. Loan payments are not all expenses. So one of those questions is, I have this a lot where maybe we have a mortgage, we've paid the mortgage, and someone calls the mortgage an expense, the actual payment of the mortgage. Same thing with the actual payment of a credit card. That is incorrect. The only thing that we can take as an expense from a loan is the interest that we may be earning, or not earning, paying on that loan, the interest that the loan is earning. Same thing with the credit card payments. The actual payment to the credit card is not an expense. We pay that to the liability itself. The act of what we spent the credit card on, so every time we swiped it or used it, right? That was the expense. So what did we buy? Why were we using the credit card? So paying the card itself is a payment back to the liability. So we'll see on our balance sheet, which we'll talk about here in a minute, we'll see the liability balance go up every time we use the credit card, and then we pay the card, the liability balance will come down. Taxes collected are not income. This is another incorrect thing that we see often, especially with sales tax, is that sometimes it comes into our bank account. We're not real sure if it's income itself, right? Where it's not real clear. Maybe we use a POS system that does a one-time deposit or a daily deposit like Square or Shopify, that those do. And that actual deposit has multiple things in it, right? And sales tax being part of it. So we want to make sure we split out the sales tax so it's actually going to a liability and we're not calling it income. Because the last thing we want to do is pay income tax on sales tax, because there is no benefit to us, obviously, to have that in our books or to show that our income is incorrectly inflated. So the payment reduces the liability. The expense happened earlier. That's what's happening with those credit cards that I was talking about. Equity. So we've talked about assets. Those are things that we own and they have a value. Liabilities are things that we owe and they have a value. And then we have equity. This is the owner's stake in the business. Equity is pretty confusing, but hopefully, after we go through this a little bit, you're going to start to understand it a little better, because equity is a hugely powerful part of bookkeeping, especially from an owner's standpoint. If you're a sole proprietor, um, partnership, or an LLC. So this is not for corporations specifically. Equity is often where we pay ourselves as a small business owner. And so being able to accurately account for equity is extremely important in keeping our books clean. And we'll talk about that here. So this is also known as the value of the business to the owner. Now, I've had the question before in equity, can we just look at equity and value our business? No, you can't. It's not that simple, but it is a big part when it comes to actually doing business valuation. So if you were looking to exit or sell your business, having your equity clean and accurate is extremely important. This is the money that the owner puts into the business. So in QuickBooks, this is going to be called owner's investment. So anytime we support the business, either by helping pay the bills or we just are infusing our own money into the business, as we often do for small business owners, then we're going to call that an owner's investment in equity. And then also where we take money out of the business. So this is where we pay ourselves as owners. In QuickBooks, this is called owner's pay and personal. You might call it an owner's draw also. This is where the money is then withdrawn. So we're able to see in equity that investment or contribution as well as that draw or that pay and personal in there. And we can keep track of it that way, so that we have a better understanding of how much money we're truly putting into the business or how much that we're paying out. And so I hear this a lot too, right? So once you start tracking this, people will say, oh my gosh, I had no idea I was putting that much money into my business, or, also, maybe you're scrutinizing yourself with the amount that you're taking out in comparison to what your other reports look like, right? But that's why it is important for us to have this in the right spot. Equity is not an expense. That's the important part. We don't want to make an investment into our business and then call it an income and pay taxes on that, because that is not what we want to do. So we want to make sure that we accurately call that an owner's investment. And this is what we will utilize, and we'll talk about that a little bit, if we accidentally, or if we still are, using our personal funds in order to purchase things for the business, right? Or we find those on our personal bank accounts. It's how the owner's relationship with the business is tracked. 100%. I put money into my business. I take money out of my business. I can see it right there. and I'm tracking it correctly. Why it is so important, it keeps your business finances accurate. We need to know um, if we are spending that money on the personal side, right? And we need to make sure that we're getting credit for it as an owner from an equity standpoint, as well as the business then being able to appropriately count for whatever those expenses were, even though we're never going to see them in a business account. It helps separate our business activity from our personal activity. This is huge. If you are a business that still is using your personal account or only one account, or maybe you just are doing both out of the same account, you want to get away from that. If you learn nothing else today, please, please, please separate your personal and your business. In the state of Ohio, we are an extremely litigious state. We have some of the biggest insurance companies right here. Therefore, everybody likes to sue everybody, right? And so I like to get on my soapbox about this and say, we form these types of companies in order to protect ourselves, right? To protect the business, to protect ourselves personally. And we want to make sure that we continue to keep that protection in place, right? And if we are commingling our money, that's what this is called, personal and business money intertwined, then we are opening ourselves up to that liability, even though we might have structured ourselves in a way that we think we're protected. So get away from that. Start using equity, money coming in as an investment, money going out as pay and personal, and you will help protect yourself as a business owner even further. Maintaining clean financial reports, also extremely important. Definitely, if we're seeking funding, a bank is going to immediately look at those financial reports and they're going to know right off the bat whether or not we can manage money or not. And that helps them determine our risk profile. So we want to make sure those are correct. Preparing for funding and financing, as I mentioned. So equity is what helps keep the business books honest. Versus personal finance, as I mentioned, this is tracking income and expenses only for the business. It's tracking more than income and expenses, right? We just talked about assets, liabilities, equity. It's excluding any kind of personal spending. So if we accidentally are using our business accounts for personal spending, or maybe we paid our car payment, or we paid our credit card directly because we had used our credit card, that's why we start to use equity so we can show that money going out, and then we are ensuring that it looks correct from the book standpoint. One thing to keep in mind as a business owner when we talk about personal versus business is sometimes as a business owner, our business is our life, right? And it is very difficult for us to separate ourselves from our business as an identity standpoint. We do need to make sure that we're separating ourselves financially. QuickBooks will try to make things more difficult on you. And I will say this, and I will show you how to fix that. I don't like when they set up the chart of accounts the way that they do. They actually put the word personal in front of several things in equity. One thing to keep in mind is when you pay yourself, no matter what you are paying yourself for, the business does not care. All that matters from a maintaining your finances standpoint is that you have noted that it was owner's pay and personal. What you do with the money after that, the business doesn't care, right? It doesn't matter if it was they were paying you because that was your wages. It doesn't matter if you're taking a vacation. It doesn't matter if you're paying your credit card. It doesn't matter if you're paying your car payment. All you need to make sure is that you have it listed as owner's pay and personal to show that you took that distribution from the company. Your books are a picture of the business, not your personal finances. So I cannot stress enough, keep everything that is personal related out of your business finances, keep it out of your financial reports. So I'm going to advise you right off the bat when you set up QuickBooks to go through and inactivate any account that might have the word personal in front of it. Yes, it's sometimes a nice way to help you keep track of things. And I think that was the intent behind what QuickBooks was doing. However, if you need to keep track of those personal things, such as, home office items, because those could be separate from business expenses, or, maybe your personal vehicle expenses, things like that, keep it on a separate system, keep it in a separate spreadsheet. Just don't even have it on your business financials. So, best practice setup is open a business bank account first and foremost. Once you have established yourself as a business, right? So, you're registered as a sole proprietor, LLC, partnership, even S Corp, C Corp, right? You've got the correct paperwork, you've got your EIN number, you can go to a bank and you can set up then a business bank account. Also, get a business debit card or a business credit card. I personally hate debit cards, I don't even use them. That's just in my own world. I think they're the worst thing ever created. From a money tracking standpoint, however, I will use a credit card. If you do not qualify for a business credit card right off the bat, you know, your business is new, right? You haven't established credit of any kind. You may not be able to get one of those. Utilize a personal credit card then, if that's what you so choose to do from a paying for things standpoint, but only use it for the business, right? So that way you're keeping things in their own account and keeping them completely separate. Just don't have one of those cards where you're crossing over and doing both um, from the same card. Keep your personal spending out of business accounts altogether. Accidents do happen, emergencies happen, right? But make sure when we're doing bookkeeping, we're putting that in that correct account and we're using those equity accounts. And then pay the owner intentionally, not randomly. So when we're starting out our businesses, one of our hardest things is to set up cash flow as well as get any kind of idea about how we should be paying ourselves and when. But get yourself in the habit of setting up a consistent, intentional payment of yourself. And whether or not you have the cash in order to pay yourself, you don't need to do that. Obviously, if you don't have the money to do it, but at least you have the option, right, to pay yourself and not as opposed to it being an afterthought. There is a question about the profits distributed to the owners. What do we call that? So when you're doing any kind of distribution to yourself, right, even if it's from a profit standpoint, now that conversation or those wordings tend to lean more towards corporations, right, S corps or C corps. But if you're distributing, that's still an equity type thing. So that's that owner's draw or that owner's distribution. If it's a partner thing, it's going to be called a partner's draw. Or partner's distribution as opposed to owner, right? So we've got more than one person in there.
Christy, really
If
quickly too,
yes,
there's one more question on equity before you leave
sure.
this section from the Q&A about how equity works if you're operating as an employee-owned cooperative. So feel free
Ooh,
to tack that on to the end of this section if you'd like. I just wanted to make sure you
yeah.
were aware of that one waiting for you.
Okay.
Thanks.
Yeah. I am not 100% sure how to answer that question. I'll be completely honest. I have not dealt in employee owned cooperatives, so that's outside of my wheelhouse. But I will look that up and get you better information on that. So if mixing happens, then use equity accounts to track owner money in and out. Do not categorize personal spending as business expenses. Flag personal transactions and clean them up. So what I mean by flagging personal transactions means, uh, do something with them, right? So whether we are going through our paper statement or we're looking at them electronically and we recognize them as a personal transaction. We're going to talk about categorizing here in a minute, right? As our second step in bookkeeping, chart of accounts being the biggest thing to get right today. The second step then is categorizing. So we're going to take those personal transactions and we're going to call those owner's draws, right? Or George, it looks like you had that question. Can we flag personal spending as owner's draws on monthly credit card statements? Absolutely. As long as you are clearly categorizing them on a monthly basis. I would definitely work to get away from having personal transactions on your business credit card. But if it has already happened and you're trying to clean up things, say you haven't done 2025 yet or whatever that may be, then yes, absolutely, that's what you would do. You would also do that on the flip side then of your personal credit card. So if you've got that other issue where maybe you use that card for personal and you've got those random business transactions that may be in there, you definitely are going to want to go through your personal transactions every month and ensure that you don't have business transactions there. And so you're going to look at every single those one of those transactions. What was the amount? What was it used for? You're going to call that an owner's investment. So the money's coming into the business. And then you're going to say what that expense was then, so that you've got that. Right. So maybe you spend it on office supplies, right? We see this a lot with places like Walmart and Amazon, where you've got multiple things that you can be purchasing on one shipment, and you're not really sure how those shipments are going to come, even with the orders. And so you're going to do a process called split if you need to, and you can call something office expense, you can call something an owner's investment, so that you can make sure that you've got those in the correct place. Because at the end of the day, the goal is we get it to the right bucket in the right way, right? So it didn't come from a business account, it came from a personal account or vice versa. And then you want to accurately track equity, right, to keep those reports reliable. I would use memos. You're going to see memos in QuickBooks also. Leave yourself notes. Your future self will thank you so much for doing that, especially if you are working with a bookkeeper that might be out of your company, right? A third party accountant, any of these types of people. Lenders in the future, you're going to be scrutinized on some of these transactions. And as long as you leave yourself just a little memo so that you remember what it was about, as soon as someone questions it, you're able to explain that to them. Okay, so next thing, how do we use these equity accounts correctly? So I've mentioned these terms. We've got owner contribution investment, business expense paid with personal funds. That's what that means, right? So contribution investment, we paid a business expense with our personal funds. So we've got to then put the money into the business and call it what it was from an expense standpoint. Then we've got the owner's draws. This is when we have a personal expense that we paid with business funds. So we've got to draw that money out. Then the business doesn't care what we used for on the other end. We don't have to say what that was for. These are the bridge between personal and business money. And we will go over these as we go through the next couple sessions as well, because inevitably there is going to be categorization questions as we move through it, how to handle it. So clean categories equal accurate reports equal better decisions, better reports mean our better ability to manage our business. Jenny, you look like you have something.
I do. We have a few clarifications that people would
Yes.
like. So, um, really quickly, so if we have a personal credit card, then it's okay to keep it solely for a business credit card to make the books clean.
Yes.
Okay,
Yes.
great. How is the money that a business owner pays themselves different from the tax paid by the business at the end of the year?
So the money that you pay yourself, this is kind of a multifolded question here. So business taxes is obviously depending on the type of business structure that you have. So if you are a corporation, you have business taxes that the corporation is paying. It's completely filed separately on your federal income taxes than your personal taxes. If you're a sole proprietor partnership LLC, that is part of your personal taxes, and that's probably what you're asking, right? So, owner's investment or owner's draws, right, become part of your 1040, your personal taxes, same as the profit off of the business, right? So, it's a little bit of a gray. I would really gray, but it's a little bit of a wash, right? But the important part is that you are keeping track of what you are paying yourself throughout the year for two reasons. One, because you're going to pay self-employment taxes on those ultimately at the end of the year, right? And your account needs that information. As well as when it comes time to do any kind of valuation on your business, they're going to want to know what you paid yourself. One important thing that I didn't say in there is that owners, unless we are W-2, and even if we are W-2, they'll do this fun thing called EBITDA when they're doing an evaluation. They won't consider us to be an expense to the business, so it doesn't affect the profitability. But that's where that blended, and I think the reason for your question is coming into play, right? So the profit and what you pay yourself are actually part of the same number. However, when you're looking at the financial reports, from a financial reporting standpoint, those are actually two separate numbers, but taxed the same. Hopefully that helped. It's very weird.
Thank you. Thank you.
Yeah.
And so just a couple more clarifications. So you can claim owner investment on a personal credit card for a startup.
Yes, because
That,
your personal credit card, if you're using your personal credit card, but it's for the business and it's a business related expense, absolutely. That is your own money that you are investing in there and paying. As long as you're paying the credit card with your personal money too, right? So you might have an investment as well as a draw if the business is making money. But it sounds like the reason for your question is the business is not making money yet. You're just spending a lot of money to get started. So good job with bootstrapping your business. That's what it sounds like you're doing. So, yeah,
absolutely.
Definitely, you want those accounted for. All those expenses to show up, though, as business expenses, and get the credit for the investment as well.
So this next one, I'm going to ask Darlene. We have a request for Christy's contact info in the chat. So maybe we can have you post the best SBC contact information there. Just make sure you select everybody so it goes out to all the attendees and we can get that person the contact information they want. Okay. So one more time, can you clarify equity versus income, the difference? So this person wants to get clear about that difference.
Okay.
That question is in the Q&A if you'd like to read it.
Owner makes. Okay, so I'm reading it in the question. So uh, and this is important. I just want to make an important clarification in the way that you asked this. So the money that the owner makes is what you would be paying yourself, right? So income is the money the business makes. So this is our sales and products, and we're going to go through income and clarify what income is. So the business, every time the business sells something, product, service, whatever it may be, that's considered income for the business, and we're accounting for it in our business finances. The money that the owner takes then can be completely unrelated to whatever that income amount is, right? So we can pay ourselves $20, $1,000, whatever we decide to do. That amount of money, whatever we choose to pay ourselves then and put in our personal account, that is the equity that I'm talking about, or those owner's draws. And so hopefully that cleared that up. All right, we're going to keep moving because we got a
Yeah.
ton of stuff to cover. And yes, we will. I promise you, these questions will continue to come up about equity. It is, as I mentioned before, the most confusing of the five, and the one that generally it's probably the first time you heard about it today. And so I'm throwing you a ton of stuff about it. And you suddenly realized, oh my gosh, I had no idea what equity was or how I was supposed to be paying myself. So we have talked about assets. Those are things that we own and they have a value. Liability, these are things that we owe and they have a value. Equity, this is the value of the business to the owner. Notice I said the same word in all three of those: value, value, value. Those are extremely important as we move along into financial reports. Next one of the five, this is number four, is income that we were just talking about. So this is the money the business earns from providing the wonderful products and services that we do. This is revenue that's generated from normal business operations. It's the result of sales or services that we delivered. Income is earned, not just received. And there's an important differentiation there. So income earned versus income received is two different things. So somebody could pay us in advance for something, right? But we haven't actually done the work yet. So they are prepaying, right? But we need to make sure that we're only counting income once we've actually earned it. And there's a specific way to handle that. I'm going to table that to the side though, because that's less common in businesses, especially when you're starting out. Usually we're earning it and receiving it right at the same time that we're doing it, or we're earning it and then we're paying for it, or someone's paying for it at a later date if we're invoicing them. So it's received later, not earlier. Samples of business income. These are sales of products, service fees, client retainers, contracts, project revenue, online sales, deposits for completed work. And these can look like a lot of different things, right? So depending on whatever our business is, this is what we're selling. What is not income? These are loans or lines of credit, owner's contributions or investments, right? I said that. Don't charge yourself. So when you put your personal money into the business, don't call it income, call it that owner's investment. Grants or program funding usually is not considered income either, and that depends on the type of grant or program funding that you've got there. Sales tax collected. I cannot say this one enough. We see it all the time. Sales tax will be combined into those POS system deposits, and the more and more electronic funds are utilized, we've got someone that's collecting both income, fees, sales tax, all that together, and they're lumping it into one sum and they're dropping it in the bank account. And a big point of contention or a big problem is that we just call that income, right? And so really it's not, our reports would never match at the end of the year. And so being able to understand where that money is coming from and how that's broken down is extremely important to have our financial statements correct. Refunds or reimbursements, these are actually going to deduct from our income. So we don't want to call them positive. We want to make sure that those are accurately accounted for as refunds or reimbursements. So they're actually going to bring the income down. Just because money hits a bank account does not mean it's income. So if we have a loan distribution, right, so that we receive a check for a loan, we definitely don't call that income. That's actually the starting balance of a loan, right? And so that's how we're paying that. Um, and it's we want to make sure if we sold something, right, product or service, that's income all day long. That's pretty clear. If it's anything else, then we're going to want to scrutinize it and make sure that we've got it in that right place. As I mentioned before, payment processors and income, payment processors deposits are often grouped. Fees are taken out before the money ever hits the bank. So therefore, that deposit doesn't even have the fee that's included. It often includes sales tax. So the deposit does not equal gross sales. And when we get into QuickBooks and we start to look at what a deposit looks like when it comes in, I'll show you how to split these out and to be able to make those corrections on the front end before you ever have the problem build up on the back end. Accurate income tracking helps you understand your true revenue. This is very, very important for multiple reasons, right? So we really need to know what our true sales are because it's how we know if what our gross margins are. This is what helps us determine if our pricing is correct, what our sales are, helps us measure our profitability accurately, helps us prepare for taxes because we can kind of see what's coming forward, as well as supporting different funding applications and making price and growth decisions. Extremely important to have those income numbers correct on there. I actually was working with a client yesterday that he somehow was duplicating his income for everything that was coming in because he was invoicing someone and he had called it the revenue line. And then he was receiving the deposit, which was the actual payment to the invoice, coming in through his bank transactions. And he was calling it the type of revenue there. And so everything in his QuickBooks financial statements duplicated his revenue. Could you imagine paying twice as many taxes as you were actually supposed to? If you are looking at your financial reports after you do all this, you suddenly see the problem quite clearly and you know how to fix it, right? But that's why it's important to do all three of these steps. Now, expenses. So, there are two types of expenses out there, and it's important that we understand both of them. So, expenses are money that the business spends to operate. So, basically, it's everything we didn't talk about so far. So, we've talked about assets, liability, equity, income, and expenses. So, expenses are everything else that's left over. Plus, it's generally the bulk of the items that you're going to see in your chart of accounts. These are the costs that are required to earn the income. These are payments for goods, services, and ongoing operations. And the two types are direct and indirect. And so when you see an expense, whether it's at the time you're spending the money, planning to spend the money, or it's already happened and you're looking at it in a bank transaction, you are going to ask yourself, is that direct or indirect? And that's how you're going to determine what type of expense you're going to call it. In QuickBooks, you will see accounts with cost of goods. Usually it's cost of goods sold, cost of labor sold, things like that. But it's cost of, and these are all your direct expenses. And the difference here is a direct expense goes into or is a result of the production of the actual sales. So if we bought something and we resold it, so what we bought that we were selling, that's going to be a cost of goods sold. Sometimes labor, if the labor wouldn't have happened unless it was producing the outcome of the sale, then that labor might be considered cost of goods sold. There's a lot of supplies and materials that can go into play depending on the type of business that we are. And really, it's the industry that you're in and your business structure will be determined what is cost of goods sold. So, an example, I used to be in the landscaping world, snow removal for a lot of years, and companies in those worlds are very heavy material based, very heavy labor based as far as the producing the outcome of the sale. They have very high cost of goods sold. On the flip side, though, SBC, we're a consulting company. We don't have any materials generally. And so our expenses from a direct standpoint are very, very low. So that affects the gross margins of our businesses too, right? So very different industries and our financial statements are going to look a lot different than each other. Even though we're both service-based businesses, however, they look very different. Then the indirect expenses, which is the category of expenses where all the accounts you're going to have the most of, these are just operating expenses. These are also called the expenses you just get to do as the result of having a business. So this is going to be rent. This is going to be advertising, as well as utilities, things like that, that are just going to happen no matter what, even if you didn't sell anything. Somebody said, how do you classify purchasing goods for your clients? They're reimbursing you. Those are still considered cost of goods sold, but they're also called reimbursable expenses. And so basically, in the end, they're going to wash themselves out. But you want to make sure that when you purchase those expenses, you call them billable. In QuickBooks, there is a box that you can check in order to get that. So cost of goods sold, as I mentioned, these can be materials or inventory. So if we're buying raw goods that we're putting together in order to sell a product, right? Um, Product cost, direct labor in some businesses I mentioned, and then packaging or shipping tied to the sale. So shipping one way, so not necessarily us receiving the product in, but the act of shipping it out to the customer, right? We wouldn't have paid that shipping expense if we weren't sending it to someone. So that actual act of shipping can be considered cost of goods sold. And if you're ever unsure about what to consider cost of goods sold in your business, definitely an accountant question. They will help you sort it out. And they're probably going to ask you a lot of the same questions that I just said, like, did it result in the sale of the product, right? And did this person, the labor that they were producing, produce the outcome of the product? I've had manufacturers ask this before from a cost of goods sold standpoint. Obviously, if it's somebody that's standing on a line that's creating the product, that's definitely cost of goods sold, right there. The act of creating the product or whatever it may be from a manufacturing standpoint. But if they're doing maintenance on that equipment, nope, that's indirect then, right? At that point, they've stepped off the line and they're doing something that isn't directly resulting in the act of the sale. And so you can see where keeping track of employees and what they're doing during the day obviously is going to affect what you're going to categorize that as. From that standpoint. So operating expenses or these indirect expenses, as I mentioned before, these are the costs that are required to run a business on a day-to-day basis. So you're going to pay it no matter what. These are rent, utilities, insurance, software subscriptions. That one can get out of control. We're going to talk about that one more. Watch that close nowadays. Advertising and marketing, professional services, office supplies. So whether or not you sell anything, you're going to have these costs as a business, and they're considered to be indirect. Why separating them matters. So separating the expenses from direct and indirect is going to help you really understand your true profitability. Can't understand your gross margin either if you don't actually separate out your cost of goods sold. At the end of the day, you could just lump them all in, call them all indirect, hand it over to your accountant, right? Say sort it out. Which a lot of businesses do. However, from a decision-making standpoint, to understand the pricing of your products and services correctly, that visibility to those numbers. You want to see where the money is really going and help make better decisions about growth. Common expense mistakes, recording loan payments. Ooh, see this so often. Recording loan payments as an expense. Remember, I said when we were talking about liabilities, the payment to a loan is not an expense. It's actually just reducing the liability itself. The only part of that payment that would be considered an expense is the interest that we were paying. Recording credit card payments as expenses, same thing. The act of paying the credit card is only reducing that liability. The actual expense was everything we swiped that card for, as well as any interest that we might be paying every month or fees. Categorizing personal spending as business expenses, right? Keep personal separate out of that. If it was a business related expense, absolutely, we're going to call that an owner's investment and then we're going to call that a business expense. But we are not going to put our personal spending in there. If we use our business account and we have personal expenses on there, I've heard of people that the debit cards are the same, right? It's the same bank and they accidentally use the wrong card. Just call it an owner's draw. At that point, the business doesn't care what you did with it. Recording equipment purchases as supplies or materials or as tools, right? And so I mentioned talk to your accountant if you buy a piece of equipment, you're not sure what to do with it. If it's over a certain value, it might actually be called an asset, not an expense. This would greatly reduce our profitability if we didn't call it an asset because we're showing it as an expense, and we want to make sure that we've got it in the correct spot. And then also using miscellaneous too often. QuickBooks will provide you with general expense, miscellaneous might be in there. You'll see uncategorized in there. Those are required accounts that QuickBooks makes you have. And when we utilize those too often, they're too vague, right? Like this is not the way to do it. Actually, it looks really bad. Your tax accountant's going to send it back to you and say, I need to know what all this miscellaneous stuff was. You don't want to drop it into those. I would advise don't even use them. QuickBooks generally gives you an account called Ask My Accountant. If you absolutely have no idea what to do with something, and it does happen, there are occasionally those out there that no matter how hard you try, you cannot figure out which bucket to put it in. Utilize that Ask My Accountant as a flag to your accountant to go back and check it, right? Or as to you to say, I don't know what to do with this one. I need to get better clarification on what this one is so that I can put it in the right spot. Don't just drop it into miscellaneous in general because you don't know, because you ultimately will end up having to figure it out in the end, anyways. Expenses categorized based on what it was for, not the vendor. I see this error a lot too, where someone will call something Amazon, just because Amazon's got multiple things, right? And it's like, oh, it's easier to call it an Amazon expense. No, it's not. You actually have to be able to say what that expense was. And as I remember, I said, Amazon could be multiple things, right? We need to split that transaction and we need to call it off supplies and subscriptions, and maybe it's cost of goods sold, right? I work with a lot of businesses that Amazon is a major supplier of a lot of the materials that they utilize or the products that they resell. Keep business and personal expenses separate. I've said it about 35 times. You'll probably hear 80 times more. Use consistent categories. So this is that part where I said, and I will hear it again because I've actually heard people say it to me. Well, I was in this workshop where Christy said, as long as I'm doing it consistently wrong, at least I'm doing it consistently. And what I mean by that is when you have someone that's helping you sort things out, if you're consistently doing it wrong, it's a lot easier to unwind it, right? As opposed to just picking and choosing because you're just not real sure. So pick a path and stick with it. What I mean by that is if you have a software subscription that's coming in every month and you're not 100% sure and you call it advertising, just keep calling it advertising until you get 100% clarification on it, right? It's a lot easier to clean up those mistakes and move them when we know where to find them. Flag unusual items instead of just guessing. And so that's what I meant by move things to Ask My Accountant if you're really not sure. If you're confident in your guess, then put it where it is, but you can always put a memo on there too, right? So that you can explain that later. And then review those expenses monthly. I don't know about you guys, but sometimes I can't remember what I did yesterday, let alone maybe even this morning. I definitely am not going to be able to go back and look at a financial, statement of maybe 5 accounts, depending on whatever it is, and remember what every single one of those transactions were for the entire month. So I say review expenses monthly. If you can get into the habit where you're doing it weekly, that's even better. The more expenses you have, you're going to want to be doing this daily, or at least have a pretty good handle on what's going on. Otherwise, you're going to be asking yourself a lot of questions, and that's usually where it's very time consuming. Consistency here is more important than perfection. The more that you do this, the more that you practice, the more that you get comfortable with it, you will move towards perfection naturally, and help to understand those. So let's see. What category are quarterly tax payments? So those are tax payments. So you're going to call those taxes paid, is the category that you're going to use there. If it is your personal quarterly tax payments, though, not business related tax payments, you're going to call those equity, right? You're going to call those an owner's draw. So it just depends on what those taxes were actually for. Do we have to save receipts if you're using a business credit card to track? So the IRS is always going to tell you yes. So having a receipt to back up anything that you're doing. It doesn't matter if it was on a business credit card. There are a lot of credit cards that now are giving you more and more information. I am going to show you a simple way to enter receipts into QuickBooks using the app for QuickBooks. We'll talk about that briefly, so that you don't actually have to save the physical piece of paper. I am one who fails tremendously at saving a piece of paper. I hate paper to begin with. I am 100% electronic human. Having an app where I can snap a picture of it, enter an expense right then, and I don't have to think about that receipt ever again is a lifesaver for me personally. Any other questions right now, Jenny? Or are we
We
good?
do. And
Okay.
I've been collecting them from the chat and the Q&A.
Okay.
So I'm thinking maybe if we can go through the ones that are quick answers right now,
Sure.
and we'll do like a lightning round, and then I'll save
Sounds
some of
good.
these more complicated ones for later on.
Got it.
Okay. So a person wanted a clarification on using a personal credit card utilized for business. Is equity the right place to put that? Or is it a different bucket?
So this could be two different things. If you are using a personal credit card only for business, then you are going to probably have that as a connected account to QuickBooks. You're going to be calling that a business account. The only difference is that it's in your personal name as opposed to the business name, right? That is the cleanest way to do it if you have a personal account. I would call everything there just out of an account. You would add it to QuickBooks as an account, so therefore, you would see that balance in your liability go up and down, right? And you wouldn't have to use the investment because technically at that point, it's not owner money, right? There was nothing personal actually involved with that. However, if it's a personal credit card that you just have business expenses on, but also have personal expenses on, you are going to not want to have that credit card anywhere near your financial statements. You're not going to have it in your credit cards as a liability. Therefore, you would use owner investment as well as owner draw, depending on how you're doing those expenses as well as then paying that payment for that credit card.
Thank
Okay.
you. What
Uh-huh.
about grant money? I don't know that you mentioned that yet. Where
So I
does that
mentioned
go?
grant money.
Oh, did
Sometimes
you?
that's called income.
Missed it.
Yeah. Sometimes it depends on the type of grant that it was. Back in the days when PPP funds and things of that nature were going out there that potentially were going to be repaid, right, but not repaid, then they turned out to be grants. There is a thing called other income, depending on the type of grant, that some of those grants may be recorded as. Again, it really comes down to what is that grant all about? Is it taxed? Is it non-taxed? Right? 100% ask your accountant on that one because there's a lot around grants that you want to make sure that you're doing absolutely correctly. And if you're a nonprofit, 90% of what I'm saying is going to sound different on the nonprofit side. So hopefully you're all for profit. So that's what I'm talking to today.
Yes.
Yes.
So a refund or reimbursement, and I believe they mean that the business receives a refund or reimbursement versus giving one to a client.
Yes. So if you receive so if you returned something, right, to the store, you bought something and returned it. I'm assuming that's what you mean by that. You are going to call that exactly what the expense was. So basically, you said the expense coming in. So maybe we called it advertising, and then we returned it. So therefore, it's going to be a negative to the advertising. So basically, it's going to wash itself out. So first, it's going to increase your advertising because you bought it, and then it's going to reduce it back down because you returned it.
Okay. Non-refundable deposits. How should
Yes.
those be
So
categorized?
those are going to stay. So that was what I was talking about at the very beginning. It's received, not earned, right? And it's depending on however you determine, right, what is non-refundable about it and when the actual earned takes place. This is definitely an accounting question in order to make sure that you're doing that correctly. But that's basically sitting in a liability, kind of like those gift cards, right? So we've got the money sitting there. It's not our money yet. It's not income. It's definitely not an asset because the money's there, and we owe somebody something at some point. And once we've converted that, then from that non-refundable standpoint, right, the job didn't happen or it didn't go through. At some point, we would end up calling that income, but not right off the bat.
Thank you. We've had a few
You're
questions
welcome.
about payment processors like
Okay.
Stripe or Square.
Yes.
So how does that work with the fees that they charge and what do you record?
Everything. You record everything. So as I mentioned before, the way that the deposits happen, it depends on the payment processor, right? So sometimes they're by transaction, sometimes they're at the end of the day if they're batching it together. And they literally will just show as one number coming into your bank account, right, as a deposit. And so there are certain pieces of information that the payment processor is going to give you off of a report to tell you what that money actually is. But there is also going to be information that is not in, there's going to be information that you have in those reports. However, there is going to be a gap in the money that exists within that deposit because they've already deducted a fee of some sort, most likely. So at the end of the day, you can connect payment processors. A lot of them will integrate with QuickBooks. I can speak firsthand. I have tested so many of them. Danger. They always go sideways. They're bad. I want to speak much better to them than I normally do. Most of the business owners that we end up working with, because of the confusion that can happen, this is a higher level thing, right? Once you get good at this, it's going to start making sense to you. You're going to be able to start using things called clearing accounts. It's going to make a lot more sense. Most small business owners, when you first start out, we would teach you, at least from our perspective, and anybody else that we trained with the way that we do things, to use journal entries in order to keep track of those things. And a journal entry is an entry that you're making in that is basically fixing what the revenue is, because the revenue would never match what those reports are, as well as making sure that the sales tax goes into the correct spot, that you are accurately accounting for those fees as expenses, and anything else that might have happened between those payment processors. So the reports from your payment processor that's going to be the key piece to the entire puzzle to be able to make all those numbers work out. And you want to make sure that you can produce a financial statement that matches the report that you have from your payment processor, right? So that's it. That's your income over here needs to be the income that's over here. And if you're just looking at that deposit that's coming in, they won't match because that's not how they're designed.
All right. I know we need to move on. There are two
Yes.
more of these categorization, quicker questions that I want to do, and
Okay.
then we'll move on for now. So
Yep.
the first one is paying subcontractors. That
Yep.
goes into, if you'll clarify for us,
Yeah, so we are going
like
to
a
talk about
1099.
subcontractors. I think in the third class, we will
Okay.
talk a lot more about subcontractors and how to set them up correctly in QuickBooks, and to make sure that we've got them accurately accounted for as subcontractors. So hold that question for a couple of weeks.
Okay. Last one.
Yep.
Home utility bills. When you are self-employed and work from home, how do those work?
Those are not in your business finances anywhere. Do not record them there. If your business is paying for them, call them an owner's draw. Keep track of them though. On the personal side, whether you're doing it in a spreadsheet or use some kind of software for your personal expenses. The reason being is obviously you can take a home office deduction on your federal taxes from your personal side, right? So we've got some things that are going to be business related and some things that are going to be personal related, and being able to keep those completely separate. Those are not actual business expenses, but you get the benefit from it on your personal taxes.
Thank you. I know we've got
You're
lots
welcome.
more to cover, so we'll move on for now and we'll get to more
Yes, we do.
questions later as
I
time
know. I'm
permits.
watching this clock go, and I'm like,
I
I don't know
know.
if we're going to get to
I
QuickBooks.
know.
Okay.
Okay.
We will, whatever we do not get to today, we will just push into class two, and we will continue to truck through this stuff. But this is a basic chart of accounts then. So when I say keep it basic, when you set up QuickBooks, if you set it up as we either get to today, or at least I show you in a video how to do it, either way, it's going to give you a chart of accounts that is so much bigger than this. But this is a basic chart of accounts. You can see the big five that I talked about over to the right-hand side. So you can see where these things kind of fall into place. But generally, every business has a checking account, which is an asset. You may have other accounts that are assets. You may have a cash on hand account. You may have a savings account, right? Investment accounts. Those are all asset accounts. If you're invoicing clients, you may have an accounts receivable. If you're actually doing inventory, which very rarely, I caution to stay away from inventory until you've been doing this for a little while. The wheels can come off the bus there really quick. That's considered an asset. Liabilities, credit card is generally a liability. Accounts payable, as I mentioned before, if you're entering bills, is a liability. You might have a loan in here, and so you would have a couple more accounts. Then we've got those equity accounts of owner's draw and owner investment that I mentioned. Everybody will have retained earnings and equity also. We're not even going to go into retained earnings today, but it's something that's important, but it will be part of equity. Then we've got our income. So whatever you're calling your income, QuickBooks will probably give you no less than 7 accounts that are all named income. It's crazy. They're just kind of giving you everything and then letting you go from there. Then we've got our cost of goods sold. There's going to be multiple cost of goods sold accounts that are going to show up in QuickBooks. Also, you may only just need one. You may need 4 or 5, depending on the type of business that you have. Rent, utilities, insurance, advertising, software, meals, vehicle travel, professional fees. These are the very common chart of accounts that almost any business can start with and do very well at starting to break down and maintain their expenses. If you need inspiration when it comes to a chart of accounts, pull a Schedule C for the IRS. You guys just all filed taxes recently. The Schedule C is a very, very compressed version of what is your income and expenses. It's also good from an inspiration standpoint because most of us are doing this because we need to file our taxes at the end of the year, right? And so we could have hundreds of accounts, but the IRS only cares about these 27 or whatever that may be. So look at that if you're unsure, should I add this account, should I not? You're ultimately going to narrow them all down into those categories anyways, or your tax accountant's going to do it for you and they're going to charge you for it, right? So step two, oh my gosh, we've only talked about step one. However, it is the single most important thing because it is the entire foundation. Once you have a good, simple chart of accounts built, this part, as we talked about categorizing, becomes much simpler. So categorizing is taking every single one of those transactions and putting it into one of those buckets or one of those accounts that you have in those chart of accounts. So you're assigning it. You're telling your bookkeeping system what that transaction was for, and you're ensuring that that money in and money out are recorded accurately. Categorizing is putting each transaction in the right place. Every transaction has to have a category. There's no option. And that is how the reports are built. So step one, get the foundation. Step two, put everything in the right bucket. Step three, voila, we're going to have a financial report. There is step three that's actually reconciling. We'll get there in a second. Accurate categorizing. It helps you understand your income and expenses. It helps you see where your money is going. It will produce financial reports that are reliable. If you're doing this, avoid confusion later. If it's wrong, your categorizing or your reports will be wrong. There is a way to fix it though, when you ultimately look at your reports though. That's why reports are step four. Categorize based on what the transaction was for, not based on who you paid, right? So no Amazon. Use the same category consistently. There, I said it again. And then separate personal and business. Maybe that's the 40th time. Think about the purpose, not about the vendor. So in categorizing, deposits do not always mean income. Deposits may include customer payments, which could be income, loans or lines of credit, right? So if we've got loan deposits coming in or we've utilized our line of credit, and so that money's coming in, we don't want to call that income. Owners' contributions, we talked about those. Those are owners' investments, owners' contributions, refunds or reimbursements. So maybe we returned something to Amazon, right? And so we've got positive money coming in. It's going to be called a deposit. That's not income, right? That's just back to whatever that expense was before. And then sales tax collected. That's definitely not income either. That's going to go into that liability. Payments or monies going out, expenses aren't always going to be called an expense. They may include loan principal payments, right? So if we're paying a loan, we're just bringing down the liability and we need to make sure that we put it against that liability account. Same thing with credit card payments. And then transfers between accounts. This is where a lot of problems can happen. So we transfer a lot of money on a daily basis when we're business owners, right? Especially if we've got multiple checking accounts that we may be pulling from. We've got a savings account. We've got our personal account that we might have transferred money to. QuickBooks doesn't always do the greatest job of being able to recognize where those accounts came from. Obviously, if you have the accounts connected, it does a lot better job because it's going to recognize a transaction happening in this account that also happened in this account. And it'll say, okay, I think that was the same transfer. between those accounts. But if you have a personal account that you're transferring money from your business account into, it's going to get pretty confused. If it's the same bank, it may think it's this one. So you're going to have to do a little bit of scrutinizing at the end of the day to make sure that you are verifying that the transfers were correct. And the reason for that is when we get to step three, when you're reconciling, you're going to start to find a lot of those mistakes. I've seen massive disasters in transfers. I cannot say it enough. I will say it when I talk about rules. Rules can be great, but they could also be the bane of your existence. A lot of it becomes because things are so big. The biggest one that I've ever seen is Chase, because Chase Bank has, tons of accounts. You can have credit cards with Chase, you can have mortgages with Chase, all these other things happening. And I had one business owner that was just all the transfers just got convoluted, and it was more than $3 million in errors that were happening. He had never looked at his financial reports though, so he didn't know, and he was trying to get a loan. So we had to unwind all of that. In fact, 3 years of information in order to help him get his finances ready in order to be successful with the loan. That was a huge project in order to be able to do that. Sometimes it's better to start over at that point. Categorizing best practices, be consistent, same type of expense, same category. Categorize by what it was for, not the vendor. Use business accounts for business spending only. As I mentioned before, if you are using a business credit card, keep just business expenses on there, right? Don't use personal. Don't use it for personal. Record transfers as transfers, not income or expenses. If you were transferring from your personal account to your business account, that's an owner's investment, right? If you're transferring from your business account to your personal account, that is the owner's draw or owner's pay in personal. Record payment processor deposits are not just sales, right? That could be lots of things included in there. We had that question before. And then add any notes. They're called memos in QuickBooks. And then review uncategorized items monthly and get them resolved. So before you can go into step three, which is reconciling, you have to have everything categorized for the prior month in order to be able to do the reconciliation process. Common mistakes. I went through all of these before, so I'm not going to reiterate them again just to save a little bit of time. But these are common mistakes that happen with categorizing. And then one-off or special transactions, we talked about fixed assets, which could be equipment, loans, computers, or vehicles, right? Maybe you don't have a category for those. Maybe you don't have something in the chart of accounts, and you're going to have to add one of those as you've purchased a new piece of equipment, as you've taken out a new loan. You're going to have to add those. Same thing with grant or program funding. You're going to have to add a new line item for those. Refunds, chargeback, reimbursements. We had a question from someone about those earlier, right? And so it's whatever that expense was for in the first place, we are going back against that same expense. Major repairs or replacements. So these could be capital improvements, leasehold improvements, things like that. Those might actually be considered assets as well. And so we might not, cue in on those. Those might be one of those that we send to the Ask My Accountant. So in the chat check-in, right? So all 115 of you that are here at the moment. So which of these, after we've talked about all of them, are you the most unsure of with categorizing? So this could be loan payments, credit card payments, owner's pay, payment processor deposits, or all of the above. Just feel free to just throw it in there. Hopefully, Jenny, that doesn't screw you up if there's any outstanding questions.
It's okay. I've been keeping track. We're good.
Okay, good. So I will take about 2 seconds here and answer any of those questions while you guys are all answering this question so we can kind of get an idea where everyone's at.
Okay, a few more questions. So, best practice to manage owner draws. This person said, is it to estimate personal deductions, pull a monthly amount from the business to the owner, or do you categorize individual credit card transactions as personal or business? Sometimes it's hard to gauge what you may need to withdraw on a monthly basis. So this person's trying to get at what's a best practice for that?
Yeah, so that's what I was meaning when I was saying be intentional, right? And so this would be if I'm actually being intentional about what I suspect or expect my projected sales to be for the month and what my expenses are. So I'm really starting to step into what cash flow looks like and really starting to manage my business. Now, at the very beginning, there's going to be a big yes, right? So I might say, I want, right? Instead of I will, I want to pay myself $100 a week, right? So I'm going to say on Friday of every week, then, am I going to pay myself the $100 this week? And that's because I'm looking at what the money coming in and the money going out is. So that's what I mean by being intentional about it. If you want to set it up for once a month, then yes, that's very common as well. There are a lot of business owners that will get more on that 2 week mantra, right? Because we typically are paying employees every 2 weeks, or we will in the future, even if we aren't right now. So it's very common to do that every 2 week thing. But yeah, get a number if you say this is what I'm going to try to fit into my budget or for my business every year or for the year, and then break that down into a month and then every 2 weeks and see if you can pay yourself that. If you can't, right, you can always pay yourself that. Yeah, owner's investment right back into the
True,
business. Shouldn't have done
true.
that.
So one more best practice question, and then we can look at our results that people put
Yep.
in. So best practice for separating sales tax out so that it's available when the time comes to pay.
Yes. So I get this question a lot too. And it is a don't look at your bank account number, right? You're going to start looking at your financial reports. And when I say things like cash flow, you're going to start looking at the cash flow. This is going to be a big step, right? So you've got to have these financial reports together first. Um, a lot of businesses will set up a separate checking account just because they know that money is coming in. I need to put it over here. I don't want to accidentally touch it because I've been in a small business before. I had a business partner. If there was money in there, they would spend it. And so sometimes you need to separate it and protect it. And with the world of business checking accounts, many of them are free to set up, right? So, if it's better for you to have that separate, then absolutely by all means do that. And so somebody just asked, is that the same as a reserve account? Not necessarily. The word of the reserve account could be one that requires signatures in order for money to be moved. It just depends on what you mean by reserve. But yeah, even from it's a savings account, it's a checking, it's just a completely separate account that you know that you're depositing money into for the purpose of utilizing that money for sales tax.
All right, thank you.
All
So
right.
looking at our responses, they're pretty consistent. Most people are saying the payment processor
Yeah.
deposits. Mm-hmm.
Yep. And
Few
that
other
should be.
answers, but that was what
Yeah.
most people are saying that they're the least clear on at this point.
Yeah, and we'll touch a little bit on payment processing. It's a next step, right? Of beyond what we're really talking about here in these basic QuickBooks. But definitely, if you are working with a payment processor, that is why we have the fabulous folks from the New York SBDC. Ask them for help, right? So that they can help you get set up and to understand what to do with those types of transactions if we don't cover that here in these classes, which I'm pretty sure we're not going to get to it. So
Thank you.
step three, moving on. We've only got about 35 minutes and so much to cover here. So reconciling, what does that mean? So reconciling, I said in step three, first we've got that foundation, then we are categorizing everything, and then we are reconciling. And what we are doing with reconciling, if you have ever balanced a checkbook before, this is a very similar process. In QuickBooks, this can be extremely simple. It can also be so painful. And it depends on whether or not your transactions feeding in or the way that you've entered things, those transfers, as I mentioned before. If those things are accurate on the front end, reconciliation is really the process where you're confirming everything in there is correct. And we're using the values. So we're using a bank statement, we're using a loan statement, and we're going through this. QuickBooks is going to do it line by line for us, especially if we've got the AI part of QuickBooks. It's going to go through and pick out things for us. It's going to check boxes for us. You guys will see this when we get to reconciling once we're in QuickBooks. And we're comparing those books to our bank or our credit card statements. We're making sure those balances are accurate. And we're finding any of those duplicates or missing transactions that may be in there. So this is helping us catch those errors. We do not want those transactions to build up in there. So when we find them, we have to do something about them. If they're a duplicate, we need to delete the duplicate, right? If it's a missing transaction, we need to add it in there. If it's in the wrong bank account or it's the wrong amount or whatever that may be, we need to fix that problem. And reconciliation is really the process in which is going to help us do that. And this makes sure that our balances are accurate. And this is really at the point in this process where we can really start to trust our financial reports, because we know that we don't have those extra items. We can reconcile basically any account can be reconciled technically in QuickBooks, definitely the ones with a value. The most common ones to do every single month are going to be like a checking, a savings, credit cards, loans, to make sure that those are accurate. Anything with a statement, though, should be reconciled. It's kind of hard to reconcile them when we don't have a statement, but there will be a point where you'll say, wait, I need to fix this account because it's wrong. I see a lot of cash on hand type accounts, so people that deal a lot in cash and the cash never hits the bank, right? Those are where we're not necessarily going to have a statement for it, but we should have some kind of backup documentation that says when the money came in and when the money went out and what that was for. We want to reconcile monthly every time we receive those statements. So statement periods can be at different times of the month. We're going to use those statements. We need to investigate the differences and resolve them. Do not just ignore them. They won't go away. They stay there forever until we do something with them. Fix the issues when we find them and then reconcile before reviewing reports. I went to help a multi-entity company one time sort out some of their problems with their financial reports. And what they found is their office manager, who was doing a fabulous job, she was doing everything right from a reconciliation standpoint. She was matching up that everything was in QuickBooks that was supposed to be. Her downfall was she wasn't actually clearing out or deleting anything that was extra, all those duplicates, millions of dollars again incorrect. So basically what that was showing on their financial statements is they were saying they had a ton of cash in their checking account and they really didn't, or they had way less cash, right? If it was a lot of expenses, than they were supposed to have. And so those numbers were never matching what the actual balances were of those accounts. You can categorize everything and still have inaccurate reports, right? Because we haven't checked those values yet. So once we've done the reconciliation process, we will cover that in QuickBooks, and you will see that happen, what that looks like. We are confident that our values are correct. We then need to go look at our reports. And what this means is we're looking at our financial reports regularly. There are two in particular that are going to show us everything that we need to know from this standpoint. Those are called our balance sheet and our profit and loss. And we're making sure that those numbers make sense. So we're going to use this information to guide our decisions. And this report's going to tell us what's happening in our business. We are going to understand how our business is performing. We're going to catch all those issues early. We're going to make informed decisions. We're going to feel more confident managing the money, and we're going to be prepared for taxes, funding, and growth. Reports are tools. They're not grades. A lot of times when we look at our reports in the first place, we go, whoa, I didn't know my profit was so high, or how is my cash so low, right? And these are the types of things that you're going to see on here. They are meant to be reviewed regularly. The more that you look at them, the more that you will understand them, and they will help you make better questions, right? Better decisions as well. You will not understand everything at once. And every day as you continue on with your business, you will probably learn something about your business when you're looking at your financial reports. One powerful thing about these reports in QuickBooks is you might say, all right, I did all this work in categorizing, but how do I know I was actually doing it right? So when I said, if you're consistently doing it wrong, at least you're consistent with it. In that consistency, you are putting it into these buckets, and right on those financial reports, you're going to be able to click into the numbers and you're going to be able to see everything that you put into one of those categories. Inevitably, when you open these financial reports, one of the first times someone will say, I didn't know we spent that much money on that, or that's wrong. We didn't spend that much money on bank charges. Well, if you click it and you look into it, you can see everything that was in there. And if you did accidentally put something in the wrong category, you can fix it then at that point. That's not affecting the values of anything. That's just moving it from one bucket to the other. And once you've gone all the way through your reports, now you've categorized, you've reconciled, you've looked at your reports, you've fixed any errors. That is the moment when your financial reports are the most accurate, and you can be pretty confident in what they're telling them. So you're looking: does the income look reasonable for a period? Remember when I talked about the business yesterday, where he was duplicating his income? Well, looking at the financial reports, that was pretty easy for him to tell. No, no, we didn't make that much money. Do the major expenses make sense? Are there large amounts in uncategorized or miscellaneous? Remember, I said try to avoid using uncategorized or miscellaneous. Does the owner activity look correct? Does the cash balance feel right? If something looks off, it probably is. Just go investigate a little bit, right? Dig in and see if you can figure out what the problem was. You are going to review these monthly after reconciliations. You can compare it to prior months so you can see how one month was performing. You can look at it from last year to this year, the more data you've got in there. You can look for trends, not just the totals. That's when you're going to start noticing that there's things that look off or have changed in the business. And you're going to use these reports then to help guide your next steps. Accurate reports will help you support cash flow planning. So reports are backwards. Cash flow planning is forward. So when I was talking about trying to figure out if I'm going to pay myself, right? What does cash flow look like? When is the money coming in? When am I paying bills? Budgeting is that plan of how we're going to spend our money, how we're going to make money throughout the year. It's going to help support those pricing decisions, preparation, and funding readiness. This is where your bookkeeping turns into management. Key step there. So to review those four steps, you're going to notice the four steps changed a little bit, but it is: number one, categorize those transactions; two, reconcile the accounts; three, review the reports; and then four, repeat monthly. This is a loop, not a one-time task. The reason I said the four changed a little bit is, I dropped chart of accounts out of there, because once you've got that simple chart of accounts set up in that foundation set, you very rarely have to do anything with it unless you're just adding an account in the future, such as if you take on a new loan, you get a new bank account, you add a new credit card, things like that. So this loop, every single month for the rest of your life as a business owner, you're categorizing, reconciling, reviewing reports, repeating monthly, or you are outsourcing it to a bookkeeper or an accountant, right? And they're doing it for you, but you are always going to be reviewing your reports. So even if you do not intend to be your bookkeeper for your business, it is important to learn everything we are talking about today so you can understand where those numbers came from and where they're going. All right, so three key statements that you will need to know. You will learn these inside and out. They will become the guidance that you need and you always knew you wanted about your business. And they are called the balance sheet, the income statement, also known as profit and loss, and the cash flow statement. First and foremost are the top two. You will get to cash flow. You will not start at cash flow. Here's a little doodle about them. So internally, this helps us track our growth. Do we have enough cash? Manage our resources? Is something a good investment? Asset management, red flags, right? So we've got to be able to look at these reports. The balance sheet, this is what I call the number two most commonly used business report. The balance sheet changes, but it doesn't change that often. So the balances of these accounts will change sometimes daily because it's a bank account, right? But overall, it's not going to quite change as rapidly. You're not going to notice it, I guess, as much when something changes on here. This is a report that at a minimum you want to look at monthly. It is an actual equation that's on here, and you'll notice of the five accounts that I mentioned, there are three that are listed on here. They're right here, kind of in the middle. They are assets, liabilities, and equity. So it's assets equals liability plus equity. If you love math, you can change that equation around and do funny things with it. But it's always going to balance. This is what the company owns and owes at a point in time. It's also the value of the business to the owner. So remember when I said there are three things that were consistent between those accounts that I had said? It's value, value, value. All of these have a value. And so when you look at the balance sheet, you're going to see a value on all those. When you look in QuickBooks, you're going to see a QuickBooks balance or a number in there. You might see zero on most of them. But you'll see an actual value on there as well. And that's an important differentiation between what the profit and loss is. So this is what we own, this is what we owe, this is what belongs to the owner. It shows our financial health. When you are looking for a loan, you are going to see this report be heavily scrutinized. There's tons of equations and ratios and things that they're going to run off of this in order to determine your risk and your suitability for funding. You're going to review that those balances look right, right? This is part of the reconciliation process to know those balances are right. Are the loan and credit balances accurate? Are the owner contributions and the draws reasonable? Does it make sense? This is asking, or this is helping you answer, where does my business stand right now? Then we've got the profit and loss statement. This is the number one most utilized report. This is the report that most business owners start with. Even if you look at the balance sheet and say, I have no idea what's going on there, this is going to be the first one that you're going to look at. And this is the one that's changing all the time because every dollar we earn and every dollar we spend is going to end up coming over to here, most likely, depending on what it is, because this is showing our income and our expenses. And we're always curious, how much money did we make? I got asked this often when I worked in other businesses, how much money did we make today? How much money did we spend today? And so I would often look at this report several times a day, especially when I was managing a team that was doing all of the entries into here, how much is spent and whether or not we made a profit or a loss, right? So the bottom of this report actually shows us our profit or our loss, right? A negative number is going to be a loss, but that's what it's showing us. And really, this is revenue minus expenses equal our net income or our loss. So we know if we're making money, this is how we determine if our pricing is right, what our gross margin is. Those types of things are going to come off of here. And we're going to want to review, does our income look accurate? Do the major expenses make sense? Is there anything unusual or missing, right? And we're going to scrutinize that and dig in a little bit more to be able to tell. Cash flow, I skipped on here for today, but cash flow is that third statement that I talked about. Cash flow looks forward, and we've got to do all of our categorizing amazingly. We've got to enter bills. If we've got invoices that we enter in QuickBooks, that's how we're going to have actual visibility into QuickBooks to be able to tell if that information is accurate. So QuickBooks overview, the reason we're here today. I don't know if we're going to get to the implementation, but we'll start. QuickBooks is a product of Intuit. It is bookkeeping software that generates reports. Keep that in mind as we go through this. Everybody wants QuickBooks to do something, including myself, that it was not designed to do. If you are using it from the standpoint that this is for bookkeeping to generate reports, you will be less frustrated. Yes, it has tons of things in it that it can do. There's tons of integrations that can happen. There's other services that it will constantly offer you. But at the end of the day, it is a bookkeeping software that generates reports. There are millions of users globally, which is why there are wonderful help menus, tons of videos out there about it. As I mentioned, I've been using it for 28 years now, I believe. QuickBooks Online is the common way that it's going to be pushing you now. It's cloud-based. There are 4 subscription levels that are there, and we're going to talk about those separate subscription levels so that you can get an idea of which direction you want to go if you want to add it. You have 2 choices when you get to this page here that says QuickBooks Online Pricing. So this is a good stepping point or a good jumping point in order to get in there. It's going to show you the plans here. I almost always, depending on the type of business that you are, though, you may need one of those higher plans, but you can upgrade into those at any point. So if you start at Simple Start, which is the cheapest, don't be fooled by the pricing that's on the screen here. That's showing you that 50% deduction for 3 months, and it might be slightly outdated. Simple Start has all the basics that you need to get started as far as bookkeeping and those basic reports. And then you can upgrade your subscription at any time. So if you find that you need things that Essentials has, if you need things that Plus has or Advanced has, obviously with the more bells and whistles that it has, the more the expense goes up as well. As I mentioned before, Simple Start is a great place to start. If you happen to be a nonprofit, if any of you are actually that, you're going to jump right into Plus because it's got the things that you need in order to manage your grants and expenditures correctly. So that is a differentiation there, but most for-profits can at least start at Simple Start. If you are a construction company or a service-based company that works on projects or jobs and things like that, you would jump into Plus pretty quickly as well so that you can get visibility into job costing and projects. But from a basic bookkeeping standpoint, everything that I talked about today, you're going to get that in Simple Start. So I did mention the app a little while ago when somebody was asking about receipts. Every QuickBooks subscription comes with the app, and you're going to want to download that onto your phone. As I mentioned before, you can capture an image of the receipt directly within the app. You can enter the expense right there. The receipt is going to be tied to the expense then forever, and you're always going to have the image of it. So when you go back and you look at all those expenses, you're going to have the images. You do not have to take a separate picture in order to have that. You can do that image directly through the app. However, there is the option if you receive bills in email or you have a receipt that was emailed to you, you can also forward that email into QuickBooks. You can also attach it on the back end as well so that you can keep it with every one of those expenses. But that is included with all the different subscription levels. You can also do mobile payments. There is an extra fee, obviously, with everything. Especially when it's related to accepting credit cards. There is now the tap to pay that is available on your phone. You don't even have to have their little sensor in order to be able to do it. So it's super convenient to accept payments. You can also send invoices, which is what this screen is, and your customer can pay directly online through this invoice link. I was really slow to adopt this personally because I didn't want the extra fee that was associated with it. However, I did dive right in because I had customers in multiple states and I didn't want to wait on checks, and the Postal Service became not so reliable. Especially around COVID time. So it was just a lot simpler to pay that extra little bit of fee to QuickBooks so that someone could literally just click that link and pay me. But that is an option as well. That's not just on the phone, right? So any invoice that you're sending, as long as you're able to receive payments through QuickBooks, you can do that. I did mention the attaching the receipts to invoice. That's just pretty much showing you what that is there. Additional features that you might find in this app is tracking mileage. I personally don't think the mileage tracker in QuickBooks is that great. Mile IQ is another one that I've used before, and that one actually is a lot better. So that's if I'm using my personal vehicle, right, for business expenses, and I want to keep track of my miles. There is a cash flow planner that's available in all versions. Time tracking, you've got to jump up a little bit. Project costing, I mentioned before, that's in plus. Payroll is an add-on feature, bill pay. QuickBooks payments, and then you can connect and sync data from other platforms also. So we talked about POS systems. A lot of those integrations, you really have to know what you're doing in order for those to be successful. They can be kind of frustrating. So you can always fall back on that journal entry information in order to sort those out. QuickBooks does have a ton of upgrades that have happened and updates just in the last not even the last full year. So they just started pushing people to the new user experience last September. The entire interface changed. So if you ever used QuickBooks before and you're just kind of coming back in here to see what's going on, it is different. It has changed. Everything will look different than it did before. It's a better user experience. Navigating is a little bit different. So it's like learning a whole new software overnight. But there is a lot of AI integrations, especially as you move up in those subscription plans, that will help you. You get what you pay for, kind of in this, and this is how they're also shoving people kind of into those higher amounts. But they will talk about those periodically in there. So if you want a visual overview, I'm not going to click into Craig's right now, and I know Jenny will share this as well. There is a sample company out there. So you have two options, depending on what you came here to do or what you were hoping to achieve. You can start your own QuickBooks subscription as we go through this, or you can opt to look at Craig's Landscaping, which is via this link here. The downfall of Craig's Landscaping, though, is that it is not going to be connected to anything. So I will go back and forth with it as long as it's playing nice with me. It was not playing nice with me the last round that we went through these. However, you can start a QuickBooks subscription and get a a free 30-day trial and not be obligated to continue it after the 30 days. You won't get any money off for it or whatever at the end of 30 days. However, it is a good option to kind of explore if you want to practice what it looks like implementing, test, adding your bank account, play around with your own transactions, right? Your own categorizing if you really want to do your own reconciliation, because there are a ton of errors in Craig's landscaping. It is truly a training ground about what not to do. And so sometimes when you're in there looking at things, it can actually be more confusing than if you were just starting fresh. But however, those are your two options if you want to start the free version or even the paid version today. Or if you want to just play with Craig's landscaping, you can use that as well. So let's talk about the QuickBooks setup and what that looks like. So this part is actually very simple. So the first thing that we're going to do is go to the pricing and we're going to choose which subscription we want. And if we want the most basic, we're going to choose that simple start. And then it's going to ask you a few questions. And by a few questions, I mean, it is not going to ask you a lot of questions. And I will send some follow-up information on this as well, because we've really only got 15 minutes. When you are in the industry part of it, the industry part is very limited. And you're really just going to choose the closest industry to your business, right? So retail, when you get in there, it's a little weird. There might be only one option for that. So just choose the closest. Then from here on out, I like to say skip for now or give it as limited information as possible. Now, the goal of this is to give it as much information as possible, right? That's what QuickBooks wants you to do. However, I always say give it the least amount of information because you obviously have someone helping you on the back end to sort back through all of this stuff. Jenny's point there, we are talking QuickBooks specifically for this class, and that's why I'm saying it's up to you if you want to start the free version, if you want to do the paid version, if you want to learn how to use it, right? That's what we're talking about here. But there are alternatives out there to QuickBooks. So if you send and track invoices, you may choose that one. If you organize your expenses, everybody's going to be organizing their expenses, but keep this as simple as possible, right? Because you are going to then want to learn how to do these one by one on the back end as opposed to just jumping right in. The reason I say skip for now, it will try to force you in the very beginning to connect your bank account. You do not want to do that. You will have to click the button in order to do the workaround to be able to get to skip for now. The same thing with invoicing. There's a lot of businesses out there that don't even invoice their clients, right? If you're using a POS system, you're never even invoicing. However, in this implementation, it will force you to click that button and you want to skip that. And not do it. And the reason I say don't connect your business that or don't connect your bank accounts yet is because you've not even looked at your chart of accounts and you've not even cleaned it up yet. And what it does when you connect your bank accounts during implementation is it immediately jumps into the AI trying to get you to categorize everything. And if you've not even seen what's on the back end, how are you going to choose what you should be categorizing on the front end, right? So I caution against that. If you've already done it, then it's already there, and there might be some cleanup to have to do. But it's a lot easier to clean up your chart of accounts when you've not already started using it for any of the items. This is the old dashboard. Sometimes when you go into Craig's Landscaping or sometimes when you start a new subscription, ironically, you will see this old dashboard. So I put it up here. That is not what it looks like anymore. Once you are in the system, though, you are going to go into settings. And so this is presuming that we're not going to be able to walk through implementation much today. And I'm going to be sending you the steps on how to get started, right? I'll create a little video of me doing it. And you guys will be able to see it. You are going to want to then go into the settings up in the top right-hand corner, accounts and settings, and you're going to make sure you're adding your business information. This is a homework thing. Once you're in there, you can play around on this with Craig's Landscaping as well. It won't save anything, but you can do this exact same process. And so you're going to add your logo up there at the top. You're going to make sure that your company information is the same. You've got your EIN number in there. The email that's customer facing, same thing with your address, right? You're going to make sure all of that information is accurate. And you're going to do that in what I call the big gear, which is the upper right-hand corner. You can kind of see this little, kind of looks like this little guy. I call it the big gear because there are little gears. Little gears are dependent on the actual part of the system that you're in, and we'll talk about those when they're in there. But go into the big gear, update those accounts and settings. Then we're going to talk about cleaning up the chart of accounts, and this is what I mean about doing before you actually connect those bank accounts. So when we go into our chart of accounts, the screen that you're going to see is going to look slightly different than this. It looks kind of like a spreadsheet, and most of the screens that you go into for QuickBooks are going to look a lot like a spreadsheet. You can actually sort these headings, just like if you had a data field on an Excel doc. I don't recommend that you do much sorting in your chart of accounts because the way that it is organized is the way that I just taught you how to look at it. Assets, liabilities, equity, income, and expenses. And so you can tell those by type. So when we look at type, so we know that bank accounts are assets. There's other current assets. There are no liabilities, not a single one in here, right? Because I don't have a single liability. Then I've got equity. If I keep scrolling down, then I'm going to get to my income accounts, and then I'm going to get to my expenses after that. So what I mean by cleanup is I'm going to look at this. The screen's a little clearer. And as I mentioned before, somebody already connected their accounts or put some money in here. I can see values where it says QuickBooks balance, right? But I'm not concerned that any of these have been used. Everything's going to be zero. When I get down to income and expenses, I'm not going to see a value because I never mentioned that income and expenses have an actual value. And this is the easiest time for me to tell they've never been used, right? So I'm going to get warnings and errors from QuickBooks. I'm going to get little deleted accounts. It's kind of a big hot mess. So this is why I say do this before you connect your bank account. You can actually go through at this point and inactivate any account that overcomplicates your life. So this is where I say simple. QuickBooks will overcomplicate your life when you start it and you want to go through and simplify it. So what we do is we just go over here to the right-hand side where this little drop-down caret is. I call this a little caret. You're going to hit it, and there's actually going to be a word that's going to say inactivate. We'll see that on the next screen. So kind of here's the drop down. It's a little fuzzy, circled right there. You want to say you want to make it inactive. When you make it inactive, it clears away from that screen. You will not be able to accidentally choose it in the future. And there is always the opportunity to bring it back, though. So if it's something that you may use in the future, you're not using it right now, you can go ahead and inactivate it. But when you do need it in the future, you can always bring it back as an option. And so how you do that is there is the little gear, as I mentioned before. We're going to click little gear and we're going to open it back up and we're going to check the box to include inactive. And then we're going to be able to see all of those. So when you're doing your homework, whether you're playing around with Craig's landscaping or you open your own system and you start to play around with this, you cannot make a mistake here is the important thing for me to say, as long as you've not categorized anything to them yet. Um, you can inactivate as many things as you want to. You can bring them back at a later date, right? So once you start the process of actually connecting bank accounts and categorizing, you can then say, oops, I might have needed that one. I tend to have a lot of things that had to do with advertising or utilities. And I accidentally inactivated those accounts. They're really, really easy to bring back then. So the second part of homework then is going to be bringing those accounts back after you've inactivated them. Again, this is going to be the practice company that you can play around with if you don't want to open your own QuickBooks. Now, because of timing, we only have about 7 minutes, and I'm sure we have about 1,000 questions that are going to come up, right? I will, right after this, create a little video of me starting a QuickBooks account using the free 30-day trial setup so that you can see step by step and follow along with what I did and then be able to do your homework on the back end. So I'll send that over to Jenny so that she can send it out to all of you as well.
Yes, and what I will do is I will add that video onto the end of this recording, so it'll
Yep.
all be in one place, one link, and but all of that information will be there with the demo actually in QuickBooks. Okay,
Perfect.
so I want to remind everybody, you are going to get a follow-up email. This follow-up email will be very important because it will have links to the recording, slides. It'll also have the link for that test drive account where you can go in and do your homework. It'll have the homework listed of what Christy's been talking about to go in and try to take care of so you understand in advance of what we'll be doing next week. So if you didn't know you were going to have homework, now you do. This is a real class.
Yes.
um,
So it is very important that you do the homework or at least attempt to, because we will start off class number two with questions. So whatever you attempted to do and you got stuck or issues that you had, that is the very first thing we will do next week when we meet. Go ahead.
Okay, and before we answer a few questions that we can get to here before the end, I first want to say thank you, everyone. You have been a fantastic group of QuickBooks learners today, and it has
Yes.
been a pleasure to be with you. Christy, thank you so much.
You're
And
welcome.
I do want to say that we'll have a survey that will show up when we shut things down in just a few minutes here. We'd love to get your feedback on how today went and how, else we can help you in the coming sessions, as well as just in general with your business. Here at the SBDC, we do a lot of educational events, and it helps us to know what small business owners are looking for with their training. Okay, there's some thank yous. Thank you for putting those in
Thank you.
there. We appreciate your
Yes.
appreciation.
And I
And
agree. Jenny is a fabulous co-host. So the person that
oh,
said that, absolutely.
hey, and there's somebody I know here today. So shout out to Martha. You're awesome. All right. We're going to do a few questions here. So we did have multiple questions about QuickBooks, great. What if I want to do something else? So I dropped some of those in the
Yep.
chat. Um, like I said in my message in the chat, we don't endorse any software at the NYSBDC. QuickBooks is a very commonly used software for small business owners, which is why we are focusing on a training for it today. But there are some alternatives there if you are interested in checking those out. Okay, so
And
I'm going
most
to,
of what you learned today would be applicable whichever system it was that you were using. So
right.
those basic items that I talked about, the terminology may be slightly different, but all the foundational items are applicable no matter what system it is.
Right. And like Christy said too, QuickBooks does have the free offer, the trial offer going on. And so if you do want to get in there and try the system, actually in the system, you are able to do that. We had some questions about discounts. So right now on their pricing page, they are offering a discount, the 50% off for 3 months. I checked, that is current. And then the free trial for 30 days, you can select either one. So we had that. And I'll just drop the link to that page in there if anybody wants to look at that, because that was one of the other questions
Yep.
um, that we got. Okay,
Yeah, and
let
that
me,
is going to be in my video as well, is that's where I'm going to go to start a new subscription, is that pricing page.
fantastic. Okay,
Yep.
so I mean, this is an important question. I want to reiterate this one more time. How often should these small business owners be in QuickBooks working in there?
As often as you need to remember what in the world is going on. And I say that because I always recommend that you, and you will hear me say this in future classes as well, start to set yourself up with some kind of schedule. If you are doing this yourself, right? So if you're hiring someone to do this, they're obviously going to have a schedule that they're sticking to. But for you yourself, a lot of business owners will say it's going to be Monday afternoon or Friday morning or Friday afternoon or whatever it is, and I'm going to block off time and defend it then, right? So in small businesses, we get pulled in 12,000 different directions. And inevitably, it is us sitting here at 8, 9 o'clock at night trying to categorize expenses, right? And that's no fun. But so get a time on your calendar and defend it. Weekly is best because that's where it's most fresh. In all honesty, if you don't have a lot of transactions, it might be once a month, right? But you might forget some of those things that were happened. But at a minimum, it needs to be once a month because you need to categorize everything and reconcile everything once a month and look at your financial reports. You will get to the point, though, as your business grows, it will be a daily thing and it will just become part of your life, just like everything else does with your business.
Yes, and we will be putting this training. We will make it available for, I don't know when it will become not current as QuickBooks updates their software. At some point, it will not be current anymore, but we're not putting
Right.
any specific time limitation on it at this time. So, um, question
There is a
about the
question
duration.
about the package that's needed.
Yes, I was going to
So
ask you to
if,
talk on
yeah,
that.
if you are a beginner, right, and you're just starting out, a simple start is the name of it. So that's the lowest cost on that pricing page that you will see.
Okay. So one other instance, I know some people have some questions. You'll be able to go back and review that categorization section that Christy talked through. Well, one thing that I don't think we had talked about yet is doing prepaid invoices and how should that be handled?
Yeah, so prepaid invoices, that goes to that whole statement that I made about revenue. That is received, not earned, right? And so there is a way to do an invoice. There is a way to receive deposits and to do prepaids. And it is part of a system setup that you need to do to ensure that those get categorized correctly so that it's not something that you're going to be doing from the bank feed, right? So it's not something that you're going to be doing the actual act of categorizing on the back end. That's going to be something on the front end that you're going to have to do from that standpoint. So you literally can create that invoice for that prepaid or that deposit. It's going to then go into those liabilities so that you've got it sitting there so that you know that you have to earn that revenue and then you can convert it to income once you've actually done that. But it's a step.
Okay. Thank you, everyone.
Yes.
I know this was like 2 hours
True.
of fire hose QuickBooks. So you'll have
It
these
is.
things to review and to help you be ready for next week when we turn the fire hose back on and learn more. Uh,
Yes.
Next week, we'll be doing a lot more within QuickBooks. And so this time was setting everything up. Next time, there will be more demonstration within the software. We look forward to seeing you next week, same time. Please join us. And just a quick reminder about that survey if you have a few minutes. We appreciate your feedback. All right. Have a great rest of your day, everyone. Bye bye.
Thank you. Bye bye.